I will.
Um, Good morning, everyone. Today we are joining Lou Farina, who is our tech expert here at the Maricopa SBDC. And I will say some housekeeping issues. If you have a question, please put them in the chat. I will enable it right now because I forgot to before this started. And then you will have a recording available on our website by the end of the day. And Lou, I am going to go ahead and turn it over to you.
Okay. Thank you, Karen, and good morning, everybody. I'm Lou Farina from the SBDC, and welcome. Thanks for taking your time to join us this morning and spend a little bit of your morning learning a little bit about angel investing. So we're here to talk about angel investing, and the title of the program is "What Makes Them Tick?" Angel investors, and my my goal here is to give you a general understanding of who angel investors are, how they think, what they expect, where to find them, and then really self-select as to if you think you are somebody who who can pursue an angel investment in your business. And if you do, um, you can come see us. We can help you out, but there are other resources available too. So I will scroll down. This is me. Um, I run the technology commercialization practice, for lack of a better word, here at the SBDC. I have a background in business and technology. I've been around the investment community both from a corporate ventures perspective and as an angel investor here in town. I'm, I've served on boards. I also review SBIRs for the National Science Foundation. So come to you speaking from experience. Just a little bit on our SBDC and who we are. And if you've not, if you're not a client and you don't know, we're part of a national network of SBDCs. These are organizations that are staffed in every state. We're in Arizona, and each state is usually broken down by geography. We're in the Maricopa Center, so we'll be talking. We are typically serve the Maricopa clientele, but if you're outside of Maricopa County, we can provide you with some resources for links to the other what we call centers in that geography region. I'm sorry. The We do a lot of things, and one of the things that we do really well is lender readiness preparation, and this is for folks that are thinking about expansion capital or working capital, SBA loans, commercial loans. Now, I don't do that very much. My background is more early stage equity and some specialty in SBIR funding, but we've got other counselors that have some banking experience. We can help you with financial review. We have some marketing skills, buying, selling, manufacturing, technology commercialization. We have some specialists in export and international trade if you're looking for export. We've got another sister group called Apex Accelerator will help you specifically with pursuing government contracts. And so we can put you in contact with them. And then disaster loan assistance, I really should be taking that off because we did a lot of that for a couple of years during the pandemic. So we do counseling. Counseling is one-on-one. You get assigned a counselor. You have a confidential relationship, and you're able to work with that counselor throughout all stages of your business. We do training, and these are free training sessions. We call webinars now. There's usually a host of them on our calendar on our website, and then we have other resources. We've got market research resources. We've got some financial analysis resources. We've got some business planning resources, and these are usually third party contracts that we have that we can provide these resources to you at no fee. So again, we are a no fee advisory service, and everything we do is no fee. So um, today, just our topics. We're going to start just generally talking about startup capital, and then we're going to go into angel investment versus venture capital. because there's a lot of, I think there's a lot of confusion sometimes, um, because venture capital teams seems to get a lot more publicity, and there's a reason why. Um, then we're going to go into some profiles of an angel investor, some demographics, some things about them, their characteristics. We're going to talk about their ROI, return on investment expectations. This is important, because of the risk that they're taking, and it's interesting for those of you who have not really been exposed to it. We'll talk about some trends and dynamics, mostly around kind of remote work and remote pitching. And they'll give you some keys to some angel groups and some platforms and how they work. And then I'll just end with some resources for you. So if you've heard the term angel investor, um, and you're looking for an investor, understanding a little bit about who they are and what they are, can really be the difference of helping you get funded or not, or even, not waste a lot of your time if if you don't really fit their profile. So, um, angel investors, right? Who are they? Well, hang on. A lot of people, they come to me and they think that they're just angels. They're just, sent from heaven to help you with your business. Well, they're not, they're really not. Now there's the other side of it. Folks say, well, yeah, we know about angel investors. They're not our friends. You got to be really careful. And while you do have to be careful, they are actually here to help. Some folks say, hey, we've heard about angel investors, but we've never actually seen one. So I will assure you that they do exist. And then others think, well, if I just find myself an angel investor, it's going to be money coming from heaven. It's just easy money, and it's going to rain down on me. Not necessarily the case. So let's just do this. Well, let me do housekeeping. I think Karen mentioned. What I'm going to do is I broke this webinar into topics. I've got a bunch of slides. I'm going to go fairly quickly, but I'm going to stop after each section and then queue up Karen to see if there's any questions in the comments. And we'll do it that way to be efficient. So anyway, startup capital. Typically for starting a business, the major sources of funds are debt, which is a loan, or equity, which is an investment. Now, I didn't mention grants here. Grants are available. Not really going to talk about them, but they really aren't sufficient enough to really start up your business. They typically are incremental. For startup capital, you will find that the first capital is the trickiest and most difficult, the first dollars to raise. And there's, for all of these things I'll show you, in particular angel investing, there's stiff competition for limited sources of financing. And it's good in a way. Competition is good because hopefully the most efficient and the best ventures will get funded. If you've been a serial entrepreneur and you've had a successful exit or two, that is, you built this, you started a business, you built your business, you took investment, you sold it for a higher value, you've returned money to your investors. And you've got a close network of investors that you've worked with before. Funding is much easier. However, the majority of us don't fall into this category. You always hear stories about people who, receive $10 million for, some unique kind of venture. And it sounds easy. Well, there could be reasons why, and it could be that they are, more serial entrepreneurs. So let's just talk, I'm here to talk about equity early stage, but I just want to talk about debt really quick because debt is an option for you. If you are early stage, if you're tech and you're pre-revenue, it's really a challenge to get a bank loan, especially, if you don't have any financial track record. And this is my little picture, how I like to poke a little fun at my banker friends, belt and suspenders. They're very risk averse, and there's a reason why. We'll talk a little bit about that, but options for debt, there's a 7A loan for working capital, for equipment. A 504 loan, which is more buildings, land, real estate, maybe long-term machinery and equipment. And there's an option for that, at some point, or maybe as an individual, you might be qualified for it without the business. So we'll talk a little bit about that. But so here's just a risk return comparison, because this is really comes down to risk versus return. So the higher risk you take in any venture, the more return you will require. Risk is the risk of the money not being returned to you. So if you take this is just a brief numeric comparison of bank loan versus an angel investor, and it highlights the risk and return. For a bank loan, let's say you had $100,000 you wanted to take out, and it was a 10% interest, and that's kind of the going rate today. Expensive money. Let's say it was 5 years. In 5 years after you've paid off your loan, you've paid back that $100,000 in interest, and the banker would get interest or profit of 27,482. So his risk would be associated with a $27,000 return. Now, if you're an angel investor and you're investing in something much more risky, and you put $100,000 in, and we're gonna talk more about this, but you're gonna look for a 10x investment return over 5 years. So after 5 years, you would be expected to pay back potentially the $100,000, not payback, but as an exit event, as usually it's an acquisition, and provide a profit to the angel investor of $1 million. Now, why $100,000 an angel investor versus a bank loan? It's all about risk. Bank loans are less risky. They are, you have credit score. We'll talk about the things that go into a bank loan. Angel investor is you got an idea, you built out a prototype, you think you can sell this thing, you might got a couple customers lined up. This could be high potential, and that's kind of the risk. So with a bank, the decision factors are experienced. You have a cash down payment. Very few loans will allow you to have zero cash down payment. 10 to 30% typically. How mature is your product? What's your personal credit collateral, right? If you own anything and you take out a business loan, you'll personally guarantee it, and they'll probably try to attach to any collateral you have, such as your house, if you had a building, etc. Do you have a good business plan? And industry sector appetite just means that banks have portfolios like investors do, and they may have a lot of let's say firms that provide IT services in their portfolio. And while you might be a lending risk, they may not want you at that point just because they have too many and they're looking for restaurants per se. So that's it on loans. I just wanted to give you a quick overview. They're available, but again, very hard for early stage companies, especially tech high growth companies. But let's just step back and just talk about there's a typical progression to funding and who funds at what point. And there's some titles here: ideation, pre-seed, seed, startup, early, expansion, later. Those are kind of arbitrary depending on who you talk to, depending on your point of view, but I'm going to use them here just to show you. So always the first money into any venture, whether you're going to a bank or going to an investor, is yourself. How much have you put in? And we say, well, what's the second? It's usually yourself. So it's important that you're invested. Then you get to the point where, well, let's look at grants. Let's look at friends and family. Let's look at crowdfunding. Let's look at maybe accelerators. Maybe there's some competitions. SBIRs, which is a specific type of grant. These are all early funding mechanisms that you typically, have to have before you move forward to talk to maybe a more sophisticated investor. And it's important. This validates you, but also you're doing something with the money, from these particular vehicles, and you're retiring some risk also. So you're advancing maybe out of the concept stage of your product or invention or business. And after that, then we can start to talk about angel investors. If if you've not invested any money and you've got no other funding, it's really hard to talk to get an angel investor to be seriously interested in you. And I have Founders Fund here, and they're kind of, I kind of lump them together. So I will talk about that in the next section. So, if you're able to engage angel investors and maybe you're able to secure an investment, which is good, it's good validation, then you could probably start to, if you need it. I mean, and now you're talking about much bigger increments, corporate venture capital. Um, they're always looking for some validation. A lot of venture capital is always looking for validation from angel groups. Have you done some due diligence? You have some investment. It's usually a good sign. And so, and corporate ventures are really kind of the venture capital arm of large corporations. And I'm not really going to spend too much time on that here. And then after that, well, not after that, yeah, there's debt, right? We talked about debt. Debt, you could pick up debt anywhere along the line, depending on your circumstance. So I'm going to pause for a second, and I'm going to just say, ask Karen if she sees any questions in the chat.
We have no questions so far.
Okay. Okay. We'll move on. So let's talk about angel investors versus venture capitalists, VC versus an angel investor. Again, often confused. So in terms of like deal sizes, angel investment, roughly it's 100K to 500K, could go up if they syndicate among groups to 750, a million, maybe on the top side. VC money, they're looking for minimum $2 million, and you got to be really something very unique for them to put 2 million in, up to, approximately 50, even $100 million. And the thought is here, VCs are limited in they have high expertise, but they've, to evaluate an investment, to do a $500,000 investment, it's the same amount of work as doing a $20 million investment. So they're looking to deploy their funds in larger chunks. If you look at the number of companies funded per year, and this is older data, but I think it still holds. Angels, there's 75,000 companies per year in the United States funded from angels, 3750 in this particular year. So the point of here, it's an order of magnitude more angel investment than there is VC investment as far as number of actual deals. The thing about angels, they're willing to invest across industry sectors. And so, this is a snapshot of maybe a year ago or so. However, it changes. You probably, you'd see AI here somewhere. I don't know where it would fit. That's probably on the top right now. But here you've got a lot of different sectors. And the reason is because angels, when they form groups, they have a diverse number of people with diverse experience. So their constituency is very broad, and they're comfortable in different areas because they may have somebody to take the lead because that person may have some domain expertise in a particular area. And you see like life sciences, healthcare, a lot of doctors join angel groups, so they usually will take the lead on at least the technical due diligence on a new product, device, procedure, etc. Now VC firms have higher degree of specialization, where the firms usually concentrate on 2 or 3 sectors. So they're narrower in their expertise, but they're deeper in their expertise, right? So, and I just threw out a couple here. I'm not going to go through all of these, but typically the partners, the limited partners, even the junior partners, and the associated consultants that work with them, really are veterans of a particular industry, and so that's how they narrow their focus, and that's also how they manage their risk. For structure and control, angels they usually take about 20%, usually no more than that. They're not looking for control. Typically they're in an advisory role. They're looked at as, friendly folks who might be able to help you if they've got some domain expertise. Once in a while, I was just, talking to somebody from one of the groups, and, they took board seats in a couple of their ventures. They'll always try to maybe have a board seat so they can have some say at least, but not always. Venture capital, they're looking for higher percentage of equity control, and they want operational voting power. So if you are, taking it, if you take money from a VC firm, you're typically going to give up a lot of control um, in that firm, in your firm. Okay, so that was a quick one. Any questions regarding? I'll just stop here for a second. No questions. Okay, and we can ask them at the end too. Maybe you're thinking about them. It's okay. Maybe I'm doing such a good job that there's no questions. I doubt that. Okay, so let's just talk about an angel investor, a profile, and who they typically are. So what constitutes an angel investor? Well, typically this first bullet kind of is where you want it. They're high net worth individuals who provide early stage capital for startup businesses. Okay, and that's the crux of it. Angel investors invest within some SEC rules. There's they're less regulated investments. They're called Reg D of the Securities Act. And to do that, they have to have some minimum qualifications. They have to be an accredited investor, and that means a net worth of $1 million, not including primary residence, annual income of at least $200,000, et cetera, et cetera. So that's like the government, says this is the minimum. If you're going to offer, if you're going to offer your potential investment with Reg D, you need to have accredited investors, and all angel investors should be accredited investors, but they all are, if this is fairly high net worth individual. However, I will tell you that most angel investors that you will meet, if they're constructing their portfolio correctly, which means portfolio means all of their investments, you'll see probably about a $5 million portfolio. And they're not going to tell you this, and this is just from experience, my experience. And if you're a 50-year-old individual with high net worth, $5 million, this is typically how, if you went to an investment advisor, this is maybe how they would, what they do, what they call asset allocation. So I put 20% in bonds, 35% in foreign stocks, 40% in domestic stocks, and 5% in alternatives. Well, what's an alternative? A small percentage of alternatives. Alternatives typically are REITs, which are real estate investment trusts. They're precious metals. They may be commodities. And they'll say private equity. Private equity is, and not the term private equity as a private equity firm, but private equity in investment in early stage companies, an angel investment. So if you had a $5 million portfolio and you wanted 5% of your money to be an angel investments, you would typically have 10 investments of $25,000, which is $250,000. $250,000 of 5 million is about 5%. And that's typically the formula for most angel investors. You say $25,000. Well, that's not 100,000. That's not 500,000. Well, typically they aggregate in groups. We'll talk more about that to come up with a, to fill out what we call a round of investment. So these are individuals, and they diversify over 10 investments or so. So, you'll never know what a high individual, the net worth of an individual, of an angel investor. They don't have to give that to you. But however, I'll tell you, a rule of thumb is the lower their net worth and the higher percentage, if they're exceeding 5% of risky investments in their portfolio, if they're 10, 20, 30, 40%, the more active they'll want to become and more curious and more information needed, a little more hand holding because it's a lot more risk. They're putting a lot more risk in their portfolio. And there's nothing you can do about it, but typically uh, it becomes a little bit of a burden. It can become a little bit of a burden. But most of them are happy to write a $25,000 check, put it in their as part of their portfolio, and walk away, hoping that there'll be a significant return at some point. I'm going to go through some of the math. Now, what do angels look for in ventures? Most important is a management team, domain expertise, also ancillary expertise. Do you have an experience as an entrepreneur? They say the horse, it's the jockey, not the horse. It's kind of what term that's used. Very important, your management team. Is it scalable and capital efficient, right? So scalable, how fast can you grow it with the minimum amount of capital? What's the most scalable, capital efficient thing we've ever invented? Software, right? So if you're a software company with high growth, you're going to be very attractive. On the other hand, if you're a hard tech, if you're building some kind of semiconductor equipment or things that are really capital intensive, and you need manufacturing to build manufacturing capacity to scale it, that's going to be much less attractive to an angel investor. They're looking for large markets that are growing. They're going to look for you to have some early traction. Your product, your service, whatever, fairly well built out, and customer, either you have some customers or potential customers fairly close to customer acquisition. They're going to want to see that you know how to mitigate risk, because even if you have the best management team, there's lots of risk in these ventures. They're well aware of the risk, well aware. Angels typically they're fairly sophisticated, so they want to know that you know what the risks are, and how you might mitigate that. You don't have to have an answer for everything, because they might be able to help you mitigate some of the risk, but nobody can cover all the risk of an early stage technical startup. Are you going to have? Do you have a financial plan? And do you have some forecasts? All forecasts are wrong, but they would like to see forecasts, and they'll tell you if it's too aggressive. You'll want to make, you paint a rosy picture is really aggressive. They'll tell you it's too aggressive. Called the hockey stick kind of forecast. If you're more conservative and want to be more realistic, they'll tell you you're not aggressive enough. So you guys can, it's typically points to discuss. And as important, an exit plan. An exit plan is a plan. If you're taking on an angel investor and you can't talk to them about how they're going to get their money out, okay, because this is an illiquid investment. There's no stocks traded. There's no way to get your money out once you put it in. The only way is typically through an acquisition. And so the exit plan typically is, who might buy your company in 5 years? What value might you have in 5 years based upon some multiples of either sales or EBITDA, which is kind of equivalent to maybe profit. And maybe give some examples. You need to provide some knowledge that you understand what the end game is. If you don't have an exit plan, honestly, there's not many that will seriously consider you, or they may help you with it, if you start it and you need some help. So okay, now so angel investors, I talked about groups. There are groups and there are individuals. Most start with groups, and even myself, coming out of a corporate ventures background, I understood a lot about risk, early stage companies, but I didn't really understand angel investing in the lower dollar amounts with pre-revenue companies. I didn't, so I joined a group and I got educated into 3, 4, or 5 years. So that's what you'll find most. And we'll talk about these groups, where to find them, who they are. But there's some guys and gals out there that are fairly sophisticated on their own, and you might meet them somewhere, and they may pursue you individually. Okay, so that's a possibility. and it's a little harder to find them. They typically find you because part of what you need to do as somebody who's raising money is make yourself visible in the community. So here are some, this is something I came across. I'll tell you, one of the groups is trying to get me to come back, and this is kind of how they're selling it. I thought it was interesting. I thought I'd share it with you. So here's their pitch to potential angel investors getting in to join a group. A group is typically comes with dues, and there's some structure around their activities. But focus on performance, curated deal flow. What does that mean? Well, that means, if you're a group, you're getting a lot of applications, and they will form some committees to help screen and narrow those down. So as an investor, I mean, I could join the group, and this group will provide me with options. I don't have to go out and curate my own deal flow. I don't have to talk to 100 people, or 100 companies. Professional screening and due diligence. We'll talk about due diligence, but the constituency has enough expertise to provide some really professional. I was actually on the screening committee for a while, in due diligence, so they can do a really good job because they have the expertise. Syndication means other angel groups, which means if angel group X here in Phoenix can only do 200,000 of your 500,000, they may reach out to angel group Y in Tucson or Denver or Utah, depending on where their connections are, and help fill out that round. It's a good opportunity for networking with other high net worth individuals. I've met a lot of interesting people with different backgrounds who you would not necessarily meet. Participating in capitalism, you're typically, if you believe in capitalism, this is the place for you. If you don't, probably not the place for you. Opportunities to mentor entrepreneurs. As as the portfolio companies move along, you have some expertise, you might have an opportunity to participate. SPVs formed for each investment to allow smaller check size. This is what I was talking about, the aggregation. So if you had 10 people, 10 constituents wanted to do $10,000, or let's say $25,000, $250,000 check, what they do is they a single purpose vehicle, special purpose vehicle, I'm sorry, which is kind of an LLC that you all invest in. The LLC invests in the venture themselves. So it allows, again, aggregation of smaller check sizes. Dealum is a platform, helps to manage the funnel. They track performance. I'm not familiar with Seraph. And there's a trade association, Angel Capital Association. You have access to their resources. They have webinars, education. That's nice, and have fun. And most of it is, for the members, it is an enjoyable experience. So I just thought I'd share that with you as to, how they're trying to attract folks. Investment vehicles, you will hear these terms. First is a priced round, and this will always be the preferred vehicle, where this is Shark Tank. This says, I'm going to give you $100,000 for 20% of your company. I'm going to give you $500,000 for 10%. This is a priced round. A valuation is established, and an ownership percentage is established. However, there are two other ways, and these are earlier: SAFE, simple agreement for future equity, and convertible note. These are, without getting into too much detail, these allow you to postpone the valuation event. I don't really know what it's valued right now. So I'm going to give you money, but when it's valued, then I'm going to establish my ownership. There's usually a cap, so you don't get diluted too much. So let's say it's $5 million. So anything after $5 million, you're limited to $5 million of basis, which means if you put $1 million into $5 million, that's 20% ownership. So that means you can't, with a cap of $5 million, with $1 million invested, you can't be diluted less than 20%, right? So just in case this thing blows up and it's worth $100 million, you have to protect yourself. And so that's how they do these two. Most angel groups prefer not to do this because they're taking on a lot of risk. They rather establish their ownership. However, it happens. Some demographics of angels, and this is a little bit dated, but still kind of holds. And I'm going to qualify this with that this is data provided by surveys. I'm not, you'll see things here that from an equity perspective might be not be what you like, but this is kind of, my job here is to kind of tell you what you're going to see when you interface with these angel groups. Okay. And so, most of the time it's male dominated. It's tech, typically tech. And so tech is typically male dominated, although females are ascending. Race, and this is kind of a touchy subject. A lot of white people, white men. Okay. So, there are others, Asian, Hispanic, Black, Native. Comes from the American Angels study. They're, by age, you'll see here, all skewed 40 and over, 50 and over. So white, older men is what most of what you'll see. Now, I will tell you, I was in an angel meeting maybe 3 months ago, 4 months ago, and the demographics didn't exactly match. And this is national average, right? If you go to the coasts, you're going to see different demographics. If you're in Chicago or if you're in the Midwest, you're going to see different kind of demographics. This is averages, but they kind of hold, and they're good for you to know. More women are becoming angels, and there are initiatives. Matter of fact, there is an angel group that is started for women as founders. It's called Golden Seeds, and they have a chapter here in town. There's a lot of entrepreneurs that, as well as people from leadership positions at larger companies. So you've got some corporate types, you've got entrepreneurs that have, made some money and want to go back and invest. You also have, like a lot of medical folks too, healthcare, and lawyers. And there are race diversity initiatives, and these race diversity initiatives have gone on even before the whole DEI movement, right around the pandemic. I mean, even when I was doing it in 2015, 14, it was recognized that diversity was important. And so there are race initiatives to try to diversify the base here. Just as a commentary, it is tech. And we've part of it is who's comfortable with tech. Well, people typically in tech or have come from tech or have been around tech. And so you'll see it's kind of self-limiting in a way. I mean, the more programs we can help with, in STEM, and serving our underserved populations and getting them through, the more accessible we are, the more you'll have a pipeline of folks who are interested in investing in this type of investment. So that's all I'll say on that. Where to start? If you're engaging with an angel investor, have your documents ready. I'll tell you what they are. Contact the local angel groups. I'll tell you who they are. Go to startup conferences. Go to any pitch contests, pitch accelerators, startup networking events. All good places to start your journey. What documents are required? Typically, a single-page executive summary. There is a fairly standard format that investors like to see. I mean, this is typically what's passed around before engagement, right? You don't really want to send out a pitch deck blind. Send out an executive summary. It's packed with a lot of information. Tells them, hey, do I want to take another look at this or take a deeper look? You'll have to have a pitch deck, because the pitch deck is just that, is something for you to pitch. It's not necessarily a standalone document. If folks who view it as a standalone document tend to make it too dense, too heavy, too much data. And that's really not the purpose. The purpose is to support you in your pitch. There's an investor deck that might be a little bit different than a pitch deck, targeted towards investors and some of the things they want to see, like exit and uses of funds. You'll have a detailed financial forecast that you'll need, and a business plan. And, the business plan, is not the 50-page business plan we wrote 10 years ago. It typically a nimble business plan, 10 to 15 pages covering the major areas. And, investors will typically require that at some point. Will they read it? No. What they'll do is they'll read the executive summary of your business plan, and then typically they go and page through it and see if it kind of matches and it all kind of hangs together. And they'll look at different sections. Some will read it, but it's almost like something you have to have. So, okay, I'm going to pause. Karen, anything?
No,
Nothing
you
yet.
are doing such a good job.
Oh gosh. Okay, great. Okay, we'll power through this. ROI, return on investment. What are their expectations and why? This is really, really important. And this is where a lot of the angels get a bad rap, but it's important to understand their perspective. Angels, why are they so selective? Why do they require such a high ROI? Well, this is a very high risk asset class. Most startups fail or lose money. That's kind of just the truth, right? I hate to say it, but it's true. And we work with them all day, but most of them in this area will either fail or lose money. When you're doing a portfolio, 10% of your investments or the startups will provide all of the upside for your given portfolio, which means 90% will do most nothing. All investments are screened for a potential of 10x to 30x return in 5 years. Let's say 5 years. So this is a pretty important story for you to tell how you're going to increase the value of your company to provide this kind of return. And here's some data. 5-year return investments on individual investments for angels. So you'll see it's a pie chart here. So if you out of 100%, 35% will just return nothing. 17% will return, maybe you get your money back. 34%, 1x to 5x, which means your money back to about 5 times your money back. 5x to 10x, about 8%. But the home runs, we call these the home runs, 30x, 10 to 30x, about 6%. This is what drives your entire portfolio, because these other colors here do not provide the risk or compensate for the risk that you need to achieve your portfolio objectives. It's a we call it risk adjusted return. So I'm going to give you a little bit of just very high level math here. Let's assume you did 10 equal investments of $25,000. So your total is $250,000. 10 times $25,000. You're looking for you'll get about a 23.3x on this portfolio, and I'll show you how, which is approximately a 27% rate of return year over year over 5 years, which is a pretty good clip. But if you look at the stock market and you just put it in an S&P index, you're going to get about 11% for doing essentially nothing. Okay, so significantly higher rate of return, but they're not making 30x or 10x, because this portfolio is not returning on each investment. So we'll go through this, right? First 5 give you nothing. They fail. They go out of business. Very common. All of mine that I've invested in are in this category. Okay. So, a couple return 1x, let's say 2 of them, and that would be $25,000 return. Let's say we've got a couple of them do 3x, $75,000 return. Okay. And then 1 is your home run, 25x. 25x on $25,000 is $625. So total portfolio return of $825 on $250,000 investments. That's where you get your 3.3x return. So that's the typical way an angel investor will look at a basket or a portfolio of 10 companies. And this is kind of what they would expect and what they would need. You got to get this home run. You don't get this home run, you're in trouble. So you screen everybody that they need to be a potential home run, even though you know that they won't. Okay. Example of a home run, 25x home run. So pre-money valuation means when you as an investor see this company, they say we're worth $1.5 million. Company would like to raise $500,000 for 25% of the company. So that post-money valuation, if you put $500,000 into a company that's worth $1.5 million, that means that company needs to be worth, at least when you write that check, $2 million. 1.5 plus 500,000 is $2 million. Let's assume there's no other investment dilution from other investors. Make it simple. Let's say the selling price for this company, you've invested at 1.5, come to a post money of 2. Selling price is $50 million in 5 years. You're able to find a buyer for it. So the firm gets $50 million on a $2 million investment. Okay. $2 million valuation. I'm sorry. It's 25x. That's your 25x. 25 times $2 million is $50 million. The individual who owns 25% of that company for the $500,000 get the 25,000 times $50 million or $12.5 million. So you invested 500, they invested 500, he's going to get 12.5 million. And at a 500, their initial investment of $500,000, that's 25x return. So that's the basic simple math on how this works from an exit perspective, valuation creation, return. I talked about this. Exit strategy is really important, right? We got to get a clear path. We got to talk about, when we tell our story, we got to have a defined exit strategy, who the acquirer is, why. And if you can get into some of the, databases, Crunchbase, etc., talk about some of the reference exits, and how their companies were valued when they were bought. This is always very powerful. Shows you understand this. It's almost like a comp, for if you did real estate, it's almost like a comp. So, and here's just a slide I like to have in here, and just there are other investors that are not angel investors. Okay, when you say angel investor, you have a really specific connotation. Angel investors looking for cash on cash return on their investment. They got a 5-year time horizon. They're looking for an exit plan. I'm going to call a strategic investor or a different type of investor, maybe investing in happy with a stake in the profits of your company. They've got a longer term time horizon. They may be some synergies with their existing business, marketing, collaboration, distribution, and there might be some development opportunities. So there are other classes of investors that invest. They're just not necessarily angel investors. They don't have this angel investor profile. Okay. How am I doing on time here? Oh, I'm doing great. Okay, great. Any questions? Karen?
No questions.
Okay. So trends and dynamics, and this is going to be really focused. This kind of came about as during the pandemic, and we all went to kind of this distributed work environment. And it's kind of stuck. It's important. I think all of us, there's hybrid work now, and while before maybe the pandemic, we all were required to go to the office. It was a local phenomenon work, right? You lived in the geography, you worked in the geography, and you went to the office, right? It was kind of the same thing with angel investment. I mean, angel investing was a local phenomenon. It was a group of local investors who were in the same territory ecosystem, who knew other people, very local kind of thing. And it was kind of there's still power in that, and it still happens, right? It's still important. But we've really kind of expanded our ability to reach out. through diverse spatial diversity. Spatial diversity means remote. It's a fancy word for remote, right? We've learned that work, and I'm going to say investment, doesn't need to be limited by physical space, right? Just as some of us work remotely now, I know folks that work out of, fairly remote places and on national jobs, right? There's quality of life benefits we've realized, but further, I think the investment community and the angel community has realized that startup teams don't necessarily even need to be located anymore. And what this really has done, once you cross that chasm, is you get increased to talent. Now I can pull talent from all over the country, maybe even all over the world, to bring into my venture. So it's been a real, there's a windfall there. Um, in capital flows, which means, I talked about angel groups being organized by geographic region, maybe state. Now it's kind of less constrained, right? There's, it's not uncommon for ventures to be, working with angel groups in other states and all done remotely, right? The venture maybe, maybe somebody's located in Utah, but a couple of them in California, one's in Nevada, the investor may be in New York. And that's possible now. It's different. That's a different paradigm than the local angel groups. However, there are still local angel groups, and they're still entrenched. So the but this brings a level of I don't know, you know how I would say this. So you need to be cognizant of in pitching and engaging over distance, remotely, because if you're here in town, people can touch, feel, see you. They'll know people who can touch, feel, see you, and that brings a level of comfort, right? With remote pitching, there's a lot more opportunity for pitching, so the volume can go up. So in order to get your business funded, you have to, be very on point. I think we all, at some point during the pandemic, experienced Zoom fatigue. And what that really has created in the investment community is shorter attention spans for remote pitching. And you can easily lose your audience in 30 seconds if you're not prepared. You could lose your audience in 30 seconds if you're doing a pitch, um, to a local group. But this is even more important. You got to make sure your pitch is second nature. You got to prepare, practice. Crisp messaging are really critical, right? I use this: be brief, be bright, be gone. You got to, when you're doing remote work and remote pitching, really important that you are polished and ready to go. And that takes preparation and working with people who can help prepare you. Okay. Karen, I'm going to switch. Any questions?
Let's see. I don't know if it's a question. Love this presentation, very helpful. Not sure if applicable, but would like to hear Lou's thoughts on angel investment for nonprofits, specifically for startup incubator phase. Any advice on what resources might be available would be appreciated.
Yeah, and well, typically investors don't invest in nonprofits, unfortunately, if that's what you're asking. Um, the nonprofits can provide good advice in preparation for for-profit companies seeking angel investors. If I said that, there are, and that's kind of what a lot of them are geared towards. I don't have, you can come see us. I can give you a list of incubators that I think are good and help prepare you. But typically the incubators are nonprofit. Some are for profit. So anyway, I'm going to move on and talk about groups versus platforms, right? So group, who's here in Arizona? Platforms. Well, now we have digital platforms, we can utilize, but they're located anywhere or everywhere virtually, right? So um, in the group, and I just want to go back to this group thought. Um, so the mechanism for investing from a group is not consensus. Okay, that's important. You may have, in let's say the group, one of the big groups here in town, they have got 100 constituents. They may have 80 at a meeting, and 80 get to see your pitch. And really, the decision is how many of you, after we go through some more work, are interested in investing? Raise your hand. 1, 2, 3, 4, 5. Oh, okay, we got 8 of you. Okay, 8 of you. We'll continue on, and we'll if you're going to invest, you're all going to put in. We're going to sell units for 25,000, and 8 are going to put in, and that's the investment we can provide. And that's how the decisions are made. There's no typically, unlike a venture capital, and I didn't say this earlier, a venture capital fund is actually a fund. That's money invested by investors that investors have put in to a fund and have limited partnership and general partners who are actively managing that fund and deploying the capital. Very different. So that's really, really important to know. And I will say this is probably for the majority of angel groups. However, there are some angel groups that do have funds. Nothing is 100%, but this is more typical aggregation of individual commitments. If you're going to engage an angel fund, okay, not an angel fund. I'm sorry, back that up. An angel group. It's kind of like a competition because, and here on my left, companies per cycle. That means there may be, let's say, 5 review cycles in a year for an angel group. It means they start and they stop, they take it, and they, anything between, for 3 months or does it, whatever it is, 8 weeks, 10 weeks. That will be we'll see those clients up for our next meeting. So they may get 50 applications in that in that quarter, let's say. They do some initial screening, 10 of them, we go from 50 to 40. 10 are just not compliant. They didn't answer the questions. They didn't fill out the application. There's no supporting documentation. Easy, out. Okay, then we take 40 and we put them through a screening committee. And a screening committee are made up of constituents from the group, and they'll typically have their own rubric, which is judging criteria, and do some scoring for these 8 after the individuals are able to actually dive deep into the material that you've provided. And they typically will come up, with 3, 2, 3, 4 for pitching. So we've went from 50, okay, to 3 for a particular pitch opportunity. And what that means is those 3, let's say 3, are able to are invited to pitch to the constituency. It may be whoever is in the meeting on the call. You may have 50, 60, 70 investors. And this is really an opportunity, right? Because now you don't have to find them. They found you. And this is great. Well, you go through and, there's some, who after the pitching, it's who wants to invest. And, one usually nobody's really interested in. Maybe there's a couple, 1 to 2 of the 3 that we want to do due diligence. Due diligence is the deep dive. They'll take somebody from the group who has some domain expertise and do a deep drill down into that company, usually by a series of meetings with the company executives. And then based on that due diligence, and I'm going to talk to you a little more about due diligence, what that means. Maybe 1 or 2 are actually invested in, or they'll negotiate some terms. And if they can get through the terms, typically there's a deal. And usually if you get through the term stage, the deal can be made. And that's really valuation. That's really, how much money is going to be put in. And there's a bunch of other deal terms that you would want to have a lawyer look at. And so these are cycles per year, cycles. I said started with 50. If I did 5 cycles, I'd go 250. So, maybe the group's getting 250 applicants a year, and maybe they're investing in 5 to 10, and that's be pretty typical for a larger size group. So um, if you talk to anybody that didn't make it through the funnel, if angel investors are investing in 10, they'll say, no, there's nobody investing. Well, they just didn't make it through the funnel. They just didn't make it. A lot of times, they're just, they'll provide feedback, right? They'll say, all right, the screening committee will provide some feedback. And a lot of times it's, hey, you're just too early for us. Come back when you've done X, Y, and Z. And that's not a no. That's just just keep going and come back when you've made a little bit more progress. Now I will tell you, when I was part of the group and we would give feedback to the um, to the applicants. About half of them we'd never even hear from. No, that we don't want any feedback. I don't know why, they just would ignore the feedback. Okay. About a quarter of them, 25%, were just mad as hell. They just wanted a piece of us, and we were wrong and they were just really angry. Only about 25%, I would say, on any given cycle would actually take the feedback and ask some questions and then move on. So that's just the way it works. So due diligence, I actually, talked about due diligence in stage 5, which is that deep drill down. Now here is the it's not proprietary, but it's a due diligence report. Matter of fact, I just received it from one of the angel groups. And I thought the table of contents would be very interesting to show you the level of detail that is really required in what subjects. And they'll do a deal summary and they'll test drive this. It was a software platform, it was a real estate software platform. They'll talk about their overview, their roadmap, how they onboard their customers. They got some questions from another realtor and real estate they may go out to some other domain experts and ask for their opinion. They'll do a competitive analysis. They'll ask about intellectual property. They'll look at your product development team and methodology. How are you going to go to market? What's your go to market strategy? Market size, potential share. How did you get there? Deep dive into the executive team. Deep dive into the financial reviews. Okay, risks, term sheet review, exit discussion. How'd that go? Summation. And so this is a 39-page report written by usually one or two folks who have done the due diligence on the company. So, I guess the message here is be prepared, be prepared to have this material and a story. And a lot of it can be, the basis for it can be your business plan if you've written it and it is well thought out. Okay, so groups, I think I've mentioned this a couple times. They could be local, and here's the local, and this is typically our perspective. And then, from this might be local, might be Arizona. Okay, there's like 3, 4, 5 groups, and I'll show you who they are. And then, typically the groups here have relationships with the Mountain West, maybe California. This might be Utah. This might be New Mexico. It might be Colorado, some of the groups there. And then there's national. There's other groups on a national level. When I say national, they're outside of this, this sphere. And so this has to do with physical location and physical operating presence. But then, on the bottom cross, there's virtual platforms that are, nationwide essentially, and they could be based on a lot of times verticals, different specialties. So they're not looking for necessarily anybody in a specific region. They're just looking for verticals. And I'll talk a little bit more about that. So here are the local groups here in Arizona. There's Arizona Tech Investors. They are located in Phoenix. Desert Angels, very active group in Tucson. Canyon Angels, they're in Phoenix too. They're at a Grand Canyon University. There's InvestU, which is a group from ASU that's been active over the last 2 or 3 years. They've done a really nice job here in the ecosystem. Here's Golden Seeds. Golden Seeds is the women focused angel group that I mentioned. So there's all of these entities have websites and intake process um, for applying, right? There's a front door. So essentially, now I'm going to talk. These are kind of, I call them angel groups, super angels, local founders funds. Some call them VC. Um, but we've got, and this is fairly new I'm new being the last 3, 4, 5 years, where we've had these particular entrepreneurs um, exit their companies and actually start their own funds with maybe a couple of other partners. And you might recognize some of the names: Greg Scoresby, you might know him; Jack Selby, AZVC. So these, and they operate on they're probably not going to do the $20 million investment. They're probably the million, the two, what we call A round, small A rounds. The A rounds typically after angels, and so they're located here. They all have some specialties, like I think Greg Phoenix Ventures more SaaS oriented, uh, um, a group fund, and then AZ Venture Development Corporation. These are government funds through the SSBCI program, and they were able to invest, and they were able to invest in some government funding into the different local funds. These funds, they couldn't invest in angel groups because angel groups don't have funds, right? And they also could invest directly into companies as long as they're not the lead investor. So somebody else take the lead. Now, Andy Lombard ran that. He started it up, and first, I think he was there 2 or 3 years, did a great job for us in the local ecosystem. And I got something on LinkedIn that he's since moved on. I don't know who's running this now, and so we'll see. But that it will, as a funding group, it will still be there. And so now if you go to the Mountain West, and this is just a smattering of who might be out there: Park City Angels out in Utah, Tech Coast Angels, not really sure where they are. Rockies Venture Club is out of Denver. New Mexico Angels, Sierra Angels. I think Tech Coast is California, is one of the big groups in California. So, and national, other, there's New York Angels. There's a bunch of Charlotte Fund, Alliance of Angels. I'm not sure. I think they're in. I'm not sure where they are. Band of Angels, North Texas Angel Network. Anyway, so there's others. There's way more here. If you did some searches, not all of them will take out of state, but many will, and so it's worth pursuing, especially if you get a referral, because a lot of times you're networking, and they may know somebody in these other angel groups, and they may be located here in Arizona, they may be in California. Say, hey, you need to talk. And you get an introduction, and that often helps too. So now the virtual ones, the ones that look at verticals, yeah, there are interesting. There's Chemical Angels Network, or more on physical, chemical oriented ventures. There's Life Science Angel Network, Angel MD, more for life sciences, health sciences oriented type of ventures. Not necessarily, again, not tied to any locale. Fashion Angel Network, I've never had anybody use them. E8 is out of Seattle. They are like renewable and energy. And then, as a matter of fact, I was talking to one of my clients the other day, and I was doing some work for him, and there's some venture or funding groups that are focused on veterans, and this happens to be one of the Veterans Venture Capital Network. So I am at a point where I'm a little, we're doing good. Any questions, Kara?
We do not have any further questions.
Okay, well, I'm going to wrap up here then. Here's some, if you're into data, or if you've had enough of what you heard here and you don't want any more, that's fine. I understand. If you've heard enough here and you think, hey, this could be something I'm interested in. It could be for me. Contact us. We set up a counseling session, work with you, see what you see where you are, and maybe help you with, help you with a lot of things, including, putting your documentation together and your engagement approach. But if you're looking for data, there are two trade organizations that provide public data: Angel Capital Association, the Angel Resource Institute. Here are the links. There are a couple. We talked about the American Angel Study. This is a little bit dated, but it's really interesting. But I mean, this is like 150 pages of demographic information on Angel, on who the American Angel is. Could be good reading for somebody. There's the Angel Funders Report. Angel Capital Association, ACA is what we call them. Every year they'll pull out a funders report, gives you the kind of the trends. And I didn't go through a lot of the trends because, they're kind of aggregate trends. I'm not sure how applicable they are to our particular market. The Halo report is from the Angel Resource Institute that provides some data on what's going on with angel investment. I will close by saying that we in Arizona have been very fortunate over the last, I'm going to say, 3 or 4 years, right? I talked about some of these venture funds, these founders funds that have popped up, but we are in kind of a growth stage with regard to the entrepreneurial network, especially in the tech space. I mean, anybody who's been following the big projects that are coming in semiconductor, in battery, in EV, these big giant capital investments, well, they've kind of shone a spotlight on Arizona, and what we've got is people coming in from other parts of the countries with their ventures in the startup ecosystem here. You got people that are coming here that are bringing money to invest. We've got people coming here that are bringing their talent to this ecosystem. So we are in we are moving up the food chain here in Arizona. It's a good place to be for angel investment. We're not equivalent to Silicon Valley. We never will be. We're not even, I don't think we're where the, California is with some of their investor, communities. Probably not equal to the East Coast either, with New York and Boston. But we're reaching kind of where maybe where Utah and Denver, Utah and Colorado are and were. So good place to be. Ken, I always caveat that with it's not an easy, raising early stage capital is not easy. It's not for the faint of heart. This is tough stuff. So can't guarantee you're going to get funded. So any more questions before
No, just a statement. Gregory says, Lou, thanks for the amazing presentation, informative and great resources.
Okay. Well, thank you everybody for joining us today. Again, contact us at the SBDC. You go to Maricopa SBDC. You can see all of our services, whether you need angel investment advice or all the other things that I discussed. We've got a lot of counselors, a lot of resources, a lot of capacity to help small businesses here in Arizona. So thank you very much.
Bye, everyone. Just remember that this presentation will be on our website, hopefully by end of day today, under recorded webinars. So thank you.
Thank you, Karen.
Okay, bye-bye.
Bye.